Well, Tata Steel, that's the company which is currently in focus, as is the stock price, reacting acutely to its numbers this morning. You've got the headline third quarter numbers. While they may be in line, but clearly it seems like the forex variations have driven a miss. So let's probe a little deeper into what the quarter went by was like and what the visibility is like going forward. I have with me the MD and CEO of Tata Steel TV, Narendran, joining in on the show right now. Mr. Narendran, good morning. Great to have you on the show. And I'm just looking at the quarterly details because, 2 quarters ago, Tata Steel Europe was clearly in a very sweet spot. Now things seem to have taken a 360-degree turn altogether. Tell me what went wrong.
Thanks, Aisha, for having me on the show. So actually, Europe has obviously had a pretty difficult year. It started with the Russia-Ukraine crisis because that resulted in two things. One is the demand side became fragile. And more importantly, the input costs, particularly the gas prices and energy prices, shot up. Gas prices and energy prices went up to 5 to 6 times the normal levels. So you see that playing out. So you had a situation where the coking coal prices went up because of what was happening between Russia and Ukraine. You had energy costs going up, gas prices going up, and demand pretty much being quite fragile. So that got reflected in our numbers, obviously in Q2 to some extent, and to a significant extent in Q3. The second thing because of which the numbers look bad is we are doing some changes to the pensions in the UK. Basically, it's getting transferred to insurance companies, which is good for us in the long term, de-risk the business quite a bit. But that process means there are some non-cash adjustments because of the deferred tax credit that we had on our books. So that was a very significant amount, almost about 2,000 crores, which also played out in the P&L and hence a negative PAT.
Okay, so let me pick up on those points one by one. Europe, in fact, Mr. Narendran, has reported loss at an EBITDA level. Now, given that second half was expected to be weaker than first half, could the situation deteriorate then in the fourth quarter before it becomes better?
No, we see the fourth quarter getting better than the third quarter for a couple of reasons. One is if you look at the third quarter numbers, while the coking coal cost came down by about $90 a ton and iron ore prices came down by about $20, our costs are showing a 31 pounds per ton increase, largely because we have taken some NRV losses on some of the stocks that we had. So that's like a bit of a one-off kind of adjustment, and that's why the EBITDA is significantly more negative than most people expected. Secondly, the volumes in Q4 will be higher than the volumes in Q3. So, and thirdly, the gas prices and energy prices have started dropping, and spot steel prices have started going up. So for these reasons, we expect Q4 to be better than Q3, though we are not totally out of the woods yet.
Okay, great. That's the clarity I guess everyone was looking out for. But could you help me quantify this? I mean, how much better or worse could it get in the fourth quarter, considering you're saying it's not going to be significantly better right away?
Yeah, so let me put it this way. I can't obviously give you a very specific number, but let me put it this way. The realizations are going to be about 70 pounds per ton lower simply because the long-term contracts have got renegotiated and the spot prices have not yet caught up with the long-term contract prices, right? So that is one part of it. But the cost will be at least 100 pounds per ton lower, okay? So that gives you some sense of what could be the margin improvement for sure. And then the volumes are going to be about 200 to 300,000 tons higher in Q4 compared to Q3 for Europe.
Okay. Sure, got the picture then. Let's talk about the India operations now. And a lot of price hikes clearly have come through in this calendar year so far. But we understand that these price hikes are just a pass-through. You think they're sufficient enough to nullify the impact of the increase in raw material prices, or do you think you'll have to undertake some more?
So I think the margin expansion has started happening in India because the margins were at its lowest level, let's say in November, because prices dropped in from October to November, started picking up in December when the international prices started going up. So we expect margin expansion to continue, but all the price increases will not flow through the bottom line because there are cost increases. May not be for this quarter, because this quarter we expect the coking coal consumption cost to be about $10 per ton lower than last quarter in India. But we are seeing that next quarter, that is Q1 of next year, some of the higher price coking coal, because today coking coal prices are in the $320 to $340 range, whereas it was about $250 to $280 range 2 months back, right? So that will start flowing through in the Q1 of next year. But overall, we see volume expansion and margin expansion continue in India.
Okay, so if I have to specifically pinpoint prices, domestic prices are currently at say about 59 to 60,000 odd per ton. Could they head to 65 to 70? I know I'm trying to put you in a spotlight here.
I think Aisha, it will depend a lot on the international markets. What happens in China after the Chinese New Year? If it comes back strongly, that will give a fillip to international prices. You would have also seen that most of the steel industry in the world over the last 2 quarters was struggling from a bottom line point of view. So we pretty much hit the bottom as far as margins are concerned for the industry. So everyone is looking at improving the margins. So it's going to reflect international prices, but clearly we are at 60,000 levels. As you know, it had gone to 75. We don't expect things to go to that level. But I think between 60 and 65 is certainly a range we are looking at.
But tell me, I know it's as much a black box for us as it is for you, but perhaps you have a better reading. What is the China situation right now?
Well, a number of things. I think, China's honestly surprised us in a positive way in the last 3, 4 weeks. Firstly, I think the decision they took on reversing the COVID policy has been hugely impactful. And a lot of consumption is coming back into China because over the last 2, 3 years, I understand the savings rate in China, which is typically about 25%, had gone up to about 35%. Just like we saw in India, once the COVID related restrictions are over, a lot of people are going to travel a lot more, spend a lot more. So that's one fillip to the economic activity. Second thing is the Chinese government has taken a number of steps to stabilize the property markets. And there's an expectation that the property markets will stabilize and is coming back because a lot of the revenues of the state or the provinces depend on the success of the property market. So there is a lot of interest in the Chinese government also to stabilize the property markets, and construction consumes 60% of the steel that is consumed in China. If you look at automobiles, they are back to 2 million vehicles a month, which is pretty close to the peak levels. So and China itself is making a change towards being a more consumption-led growth. So you may not see the 8 to 10% growth they had in the past, but I think they're expecting a 5% growth for an economy of that size. 5% is a lot of growth. And I think that's why we're quite positive about China. And, the other interesting thing, Aisha, is even though China went through a very difficult year, Chinese exports was never the problem over the last 6, 7 months, right? So even in difficult times, we have not been impacted by exports from China. That's positive for the steel industry globally because that was a big challenge that we had to deal with maybe 4 or 5 years back.
Sure, yeah, they've been delayed, but they've definitely not stalled at all. And I must say that you're more of a China expert. You've got all the numbers on your fingertips. Sign of times.
Yeah, they consume more than 50% of the steel, so I need to probably know the Chinese market better than I know the Indian market.
Next time we have a show on China, we're going to call you. But anyway, coming back to your numbers, and I want to talk about, the demand, both export as well as domestic. Because, clearly exports for the last few quarters were impacted because of this export duty imposition. Now that that has been rolled back, I wanted to understand if you're getting enough export queries for export volumes to rise in the coming quarters.
As an industry, Aisha, I think India should be exporting far more steel than we do today, right? There's no reason why Japan or a Korea or China, which imports iron ore, should be exporting steel, whereas India, with all the iron ore in the world, is having to become a net importer of steel, let alone be an exporter of steel, right? It defies logic. So one is we should encourage exports, and I think in India, we should set a target that why can't we export 30, 40, 50 million tons of steel, because Japan or a Korea exports 30 million tons or 40 million tons, right? So I think that is at a very fundamental level, and we've talked to the government about it, and I think they see the opportunity and the value in that. That is one part of it. As far as the current situation is concerned, international prices are strong, export opportunities are there, but I think for Tata Steel, exports has always been only about 10 to 15%, because we have a very strong franchise in the domestic market, and we like to first sell in the domestic markets before we export. But exports is a good option for all of us to have because this is a very volatile industry. And we cannot be building capacity only keeping domestic demand in mind. I think if the steel industry needs to get the private sector investment back on track, then the steel industry needs to invest, having this option of exports. If that export option is closed, then everyone in the steel industry will only build as much capacity as is required for India, which is detrimental for the country and for the industry. So I think at a policy level, it's the right thing to do, to go back to removing the export duty. At an opportunity level, I think there is huge opportunity for Indian companies. Specifically for Tata Steel, I think we will stick with 10 to 15% exports because our domestic requirement is quite strong.
Okay, so let me get this right. Is domestic demand and prices that lucrative that exports are being resorted to, or is it only to reduce inventory position?
It works both ways. So, for instance, sometimes the export opportunities in the European markets are good for Indian exporters. For Tata Steel, since we already have a footprint in Europe, it makes more sense for us to leverage those opportunities out of our European business. So that's one reason why, let's say, we would be exporting less to Europe than some of our peers in the industry. Secondly, some of our peers are on the western coast of India. So if they export to the Middle East, the freight is lower. Whereas for us, the freight is higher. So there are different reasons why different companies would be exporting. One of the reasons is, of course, the bottom line. The other is to find a balance for the inventory if there's an inventory buildup. And we have a fairly large, we have a 50% market share, for instance, for sales to the auto industry. So we want to obviously take care of those customers who depend a lot on us before we export.
Sure. Tell me, which sectors is the demand largely coming from?
So in India, the demand is strong with auto. Auto has gone back to the levels that we last saw in 2019, particularly commercial vehicles, because the steel intensity is highest for commercial vehicles as compared to passenger or two-wheeler.
Sure.
Two-wheeler sales are a bit low, particularly motorcycles, which is more a reflection of the fragility of the rural demand. Construction is not been as strong as we thought it would be, but I think we are seeing it come back this quarter. Last 2 quarters, it's been good, but not as good as we thought. I think things are improving, and also with the government focus on infrastructure and a further increase in the allocation for construction and infrastructure, we see steel demand to continue to be strong. The Jal Shakti mission, the oil and gas investments in renewables, because pretty much steel is used everywhere. We see a lot of demand coming out of investments in supply chains and warehousing. So there are multiple segments of consumption which is looking quite strong in India. I think the problem last year was that because exports was not an option, you had 15% or 20% of steel capacity in India really looking for a market, because we always produced about 50 to 20% more than the domestic demand required.
Sure. But tell me, when I talk about your debt picture, while for Tata Steel, the consolidated debt has largely remained stable, but is there a deleveraging roadmap that you're looking at closely?
So, Aisha, what we had said a few years back is we would like to deleverage by at least $1 billion a year. We did that and more in the last 3 years. This year, the year which has gone by, has been a year where we have not been able to meet the target for multiple reasons. One is it's been a very challenging year with the commodity prices fluctuating the way they did, particularly coal prices, also gas prices, energy costs, etc. Secondly, demand being disrupted a bit because of what happened in Europe. Thirdly, we as a company also spent 12,000 crores acquiring Neelachal Ispat. So for these reasons, we've not been able to hit that goal. But our commitment to that goal continues. Even last quarter, if you see, despite spending 3,500 crores of capex, despite all the challenges in the business that we talked about, we kept the net debt at 71,000 crores, which was what it was end of September. So we are committed to deleveraging. Obviously, there would be quarters or there would be a year like the one which has gone by where it would be a challenge, but the long-term commitment continues to be there, and we hope to be back on track next year.
Is there a set target that you've set for next year to bring down the debt?
Yeah. So certainly we will focus on the debt reduction, and we'll make our plans for next year, which keeps the debt reduction in mind.
Okay, I was looking for a number, but that's okay for some other time then. I want to talk about Tata Steel UK before we wind up because there are some news reports which are indicating that the UK government is planning to grant support to Tata Steel for to try and transition to green steel. I want to understand what exactly are the stocks, the talks right now, and where do things stand, and whether you're getting active support from the UK government for this transition.
So, Aisha, the UK government is actively involved in a conversation with us. We had sent them a proposal; they have sent us another proposal. So, we are in discussion to see, whether we can find a solution that works for everyone. Obviously, from a UK government point of view, they have a commitment as a nation to become greener, and the steel industry is a very important part of that transition into a greener future. We are a very important part of the manufacturing ecosystem in the UK. So hence we're looking at what could be the way forward. Like I said, the conversations are going on. UK has an advantage of having scrap. They export scrap. You can make greener steel using scrap than by importing iron ore or coal. But UK has a disadvantage in terms of high energy costs. So these are the conversations that we're having. The other point is all across Europe, basically steel companies are telling governments that there has to be some capex support for the transition. The general ask is 50% of the transition costs, capex cost for transition should be supported by the government in ways of grants, etc. And there has to be some support in OPEX because coal prices, metallurgical coal prices reflected steel prices. Whereas if you switch from metallurgical coal to gas or hydrogen prices need not reflect steel prices. So how do you secure your OPEX, in such an environment? And that's why all steel companies in Europe are having conversations with the relevant governments to see what is the OPEX support that can also be provided. So these are conversations going on. I think over the next year or two, multiple countries in Europe will make their roadmap and hopefully we'll be part of it.
But do you think this ask is going to be granted from the UK government? And I ask purely because their own economy is in a very fragile state.
Absolutely. So there are obviously limitations on what support they can give us. Obviously, from our point of view, we need to look at whether that support is enough, or if not, what do we do? So these are the conversations which are going on just now. But yes, there is
Contemplating
active
to
engagement from
exit
both
UK
sides.
altogether, are you?
Sorry?
You're not contemplating a altogether UK exit, are you?
So Aisha, anything that we do has a cost implication, right? So we just need to think about what is the best way forward and evaluate what is best for Tata Steel.
So you're open to exiting altogether.
I don't want to say that because it's too early to say that. But I think we have explored all options, or we've done a lot over the last many years, and we are continuing to explore options.
Okay, fair point. We'll leave it at that. Mr. Narendran, always great chatting with you. Thank you so much for your time.
Thanks, Aisha.